And I think it's one of those that really affects, our political life, our civic life. And, if you listen to the elephants and the donkeys debate, whether it's on the floor of Congress or, prior to an election, really what the big debate is over equality versus efficiency. We all know that market economies most efficiently allocate goods and services because the price system gets goods and services and labor and workers and everybody else to their most efficient use. The invisible hand works and gets, puts resources to their most efficient use and eliminates a lot of misallocation of resources because of that. But the reality is that market economies are inherently unequal. And, that is, some would say, a feature, and some would say it's a bug. And so, and I think one of the reasons why we saw market economies are inherently unequal is this chart that we were just looking at, where you can see there's a positive correlation between unemployment and education, or there's a negative correlation between unemployment and education. The more education you get, the less likely you are to be unemployed, right? And there's a positive correlation between education and how much money you make. The more education you have, and really it comes down to skills as much as anything. The more skills you have, the more money you're going to make. And, as Elon Musk posted on Twitter a few weeks ago, essentially you're going to get paid based on how irreplaceable you are. The less likely you are to need to be replaceable, the more money you're going to make. And so people who have very unique skills are in high demand. People who don't, who are fairly easily replaceable, are in fairly low demand, and their wages, their wages and their pay reflect that. And then you look at the fact as well, you add in this class of entrepreneurs. They are the business owners that hire workers. But remember, they are taking risks. They have risked capital. They have risked their lives. They put, their life savings on the line in some cases to start a business. Again, 2/3 of businesses fail. And so, you have a few businesses that do very well, and obviously their leaders make really, really good money. And you have a bunch of businesses that fail, and their leaders don't, because they're not making any money, or they don't make as much as they would have had otherwise. So we have, in the United States, and really in every country that's not North Korea or Cuba, an uneven distribution of income. This is not unusual. It exists in European countries. It exists, really in just about every country and every economy. Even in places where they try to enforce equality, like North Korea, there is some degree of uneven distribution of income. The average peasant who's working in the fields, using 1800s farming methods in North Korea probably does not live the same life that Kim Jong-un lives, right? So, when your book was published, and it was pointed out in 2013, the highest 20% of incomes held 49% of the country's wealth, and the lowest 20% held 4% of the country's wealth, and that's pretty common. We use something called the Gini index, the GINI index, to measure income inequality. And so in the United States, it kind of rates, it rates fairly in the, it kind of rates in the middle. And so, and I'm going to pull up the Gini index here really quickly. And the World Bank has this here. So I'm going to pull this up. This is the most recent value here of the Gini index, which measures inequality. And essentially, the higher the number, the greater the level of inequality here. And you see that, South Africa and a number of poor, fairly poor countries are here. They've got really high levels of inequality. Venezuela. Now, granted, this was before this is 2006, so it's fairly old numbers. Has a pretty high Gini index. In other words, a lot of inequality. And so, and you come down to, as you scroll down, you can see a little bit more. The countries with the lowest inequality: Slovenia, the Czech Republic, Slovakia, Belarus. So, you can take a look here. And so this is a way of measuring inequality. And the United States, it kind of measures somewhere here in the middle. And so I'm going to take a look here at this here. So, the United States 41.1 is our Gini index. So we're a little bit less than Venezuela. We're a little bit more than a lot of Western European countries. So, so inequality is kind of one thing, but the other thing we're looking at is efficiency. Okay, how much do you try to force equality versus efficiency? Because every move you make to create equality is going to lead to less efficiency and thus less wealth in your economy. And you can see generally countries that are higher on the Gini index, in other words, or lower on the Gini index, the countries that have a lower level of inequality generally do not have the same overall standard of living. And so you have essentially this trade-off between incentive. The fewer taxes you have, the fewer, the less government spending you have, the fewer essentially social programs, military spending, whatever. Essentially, the less you tax your citizens, the more efficiency you're going to have in your economy, and thus you're going to have more incentive for producers, for businesses to produce goods and services, and thus they hire more workers, and those workers do well. And so everybody's standard of living goes up, even though that standard of living may be unequal. Everybody's standard of living goes up. And so the other trade-off is equality, where there's little incentive to do better because a lot of that money may be going to taxes to be redistributed to people who don't have as much. So those economies are generally significantly less productive and have a lower standard of living overall. So we look at poverty, and one thing, poverty, we often, I think, ask the wrong question. A lot of people want to ask, what causes poverty and how do we fix it? And, the government's attempts to fix poverty have not gone very well for the last 45 or so years, because the poverty level has pretty much stayed pretty constant after it had been dropping significantly before the significant anti-poverty measures started by Lyndon Johnson in 1965. But the one thing that we see, we often ask, what causes poverty? How can we fix it? I think we need to flip that question around. Poverty is the natural state of humanity. What causes prosperity and how do we have more of it, I think, is the question we need to be asking. And I think that's what we have been trying to answer throughout this course. And we'll be doing a little bit more of that as we switch to the macro side next week and look at that for the last 4 weeks of the course. But people who are seeing, poverty kind of has a couple of different definitions. Absolute poverty is anybody who lives below the poverty line, which is kind of the rate of subsistence that's set by the government. Basically, what is the minimum level of income you need to basically be able to have food, shelter, and maybe minimal transportation? In the United States in 2020, that's $12,760 per person. And then it goes up by about $4,500 for each person in your household. So for a family of 4, it's about $25,000. So if you make less than that, you are considered to be in absolute poverty. And the government often has programs to help provide assistance either for food or for housing or for other basic needs. Relative poverty is basically any income that puts you in that bottom 20%. And so those are people who maybe make more than the poverty line, but are still in the lowest fifth. So that's obviously a moving target. The one thing we know about the American system is that people generally do not stay in their quote unquote social class. Most people will be in 4 or the 5, what we call quintiles, or all 5 during their lifetime. That, they generally might start off in the lowest 20%, and then gradually, as they develop more skills, experience, work their way up, they might move into the next 20%, and then the middle 20. And then maybe by the time they're about to retire, they're in that second highest 20%. Most people who are in the highest 20% do not stay there. They're usually there for 1 or 2 years because they maybe got a windfall, they got a big inheritance, their business did really well for 1 year, they sold their business. They're in that top 20% category for 1 or 2 years, and then they fall back toward the middle. So, so relative poverty is just whoever's in that bottom 20%. And so, those are people who maybe are able to, take care of their own needs, but they just don't have as much as other people. So, and so that's going to be, there's more people in relative poverty than absolute, because generally about 14 to 15% of Americans are below the poverty line. So what does the government do to try to deal with poverty? And they've done quite a few things. Lyndon Johnson in the 60s created this very expansive war on poverty. And, part of that was investments in, federal investments in really poor areas, like, building roads in Appalachia to try to help out, to try to bring, make it easier for communities to have access to jobs, building, and, this enticing businesses to take advantage of this new access and open factories in Appalachia. So that's one thing, jobs programs. There's a few others that have been proposed, where, Jack Kemp in the 80s proposed these things called enterprise zones, where maybe we would, in an impoverished area or an impoverished community, we would remove all state and local taxes or federal, like property taxes and things like that, to encourage businesses to operate in those areas and hire local workers. There's cash transfers. One way of doing that, these kind of first 4 here are cash transfers. Social Security, which is retirement compensation. Again, that costs us about 15% of our paycheck. The Earned Income Tax Credit, if you're generally below the poverty line, you get what's called the Earned Income Tax Credit, which is a refundable tax credit to low wage earners. It's designed to offset the Social Security taxes you paid and essentially refund you for those. It kind of works as a negative income tax, where people who maybe don't owe federal taxes will still get a tax refund because there is a tax credit there. Unemployment compensation is obviously compensation granted to workers who have lost their job through no fault of their own. And temporary assistance to needy families, TINF, is kind of what we refer to as quote unquote welfare. It's cash payments to families in need. This was reformed in the mid-90s when Bill Clinton was president. And it generally requires you to either have work or be actively looking for work within a couple of years of receiving your first payment. And so that T stands for temporary. And that was in response to criticisms of the existing welfare system, that people were essentially, using that for their subsistence and thus were disincentivized from getting jobs. And so, it's believed the best anti-poverty program is a job. So, let's try to incentivize people. Yes, we'll help people out who need that help, but let's try to incentivize them to move into the workforce and thus be able to provide for themselves rather than have government providing for them. Or, and again, where does government get its money? The taxpayers. So rather than having the taxpayers provide for them. There are also things like Medicare, which is healthcare for seniors. So people who are retired have government-funded health insurance. There's Medicaid. So people below a certain income amount, and it's a percentage of the poverty level, it's over 100% of the poverty line, but families whose incomes are below that amount are eligible for Medicaid, which is government-funded health insurance for those people. So those who are most in need have access, and have always, since 1965, had access to government-funded health insurance. We have SNAP, also known as, what was previously known as food stamps, which is government-funded food assistance. Today, it comes in the form of an EBT card, where it's kind of like a debit card that you can only use to buy food, and they load money on it usually once or twice a month, and then you can use that to buy your groceries. And so Section 8 is housing vouchers to help people pay for housing who are, again, below a certain amount. And how much rent you pay and how much is subsidized by the government is based on your income. And so there are some landlords who take Section 8, and there are some who do not. But there's government-funded housing assistance. And so that's kind of the last of or not the last. This is not an exhaustive list, but these are some of the anti-poverty programs. And so it's kind of that way that we balance equality with efficiency. You can never achieve complete equality while also having an efficient, prosperous economy. Ask the communists. They have tried. It has failed miserably time after time after time again. Failed in the Soviet Union. It failed in Eastern Europe. It has largely failed in China, which is why they've moved to a market economy, even though the state still has some significant oversight of it. It's failed in Cuba. It's failed miserably in North Korea. You can't, it's difficult to have equality and prosperity because the attempt to force equality requires the government to basically take over the economy and redistribute wealth. And that requires a significant amount of central planning that takes the price system out of things. And because of that, we know that central planners cannot have enough knowledge to allocate as many goods and services to the people who need them in the quantities that they need or want them. And the other thing is that planners' biases often, come in, and there's what we call moral hazard as well. People making the decisions don't have to suffer the consequences of them. So, that's how you get big, blocky, ugly apartment buildings and say, okay, this is your home. We've given you housing. It may not be the kind of housing you want, but we've given you housing, and so forth and so on. So those are kind of some basic ways, though, that we at least try to fight poverty by making sure there's a minimum level of subsistence. And obviously, then the trade-off is we give up some efficiency and prosperity in the economy because there's a level of taxation that needs to be done, or in our case, a level of borrowing, which will lead to inflation. But there's a level of taxation or borrowing that needs to happen to pay for those things. And so there's essentially a transfer of income from those who are making, and producing wealth and generating wealth to those who need more help in doing so, and maybe at least getting a start. And so this is really where the debate over the minimum wage, going back to the paper that you're writing, comes from. Those who are advocating for a higher minimum wage see it as kind of a justice thing. They see it as something to further more equality, whereas those who are opposed to it see it as something that is going to create less efficiency in the economy by essentially making it more difficult for less skilled workers, teenagers, or maybe people with a little bit less education and skills to access the workforce, get a job, and therefore be able to reap the benefits of having, work and being able to kind of climb that ladder out of the bottom 20% up to higher levels by, say, working their way up within the company or developing enough skills where they'll be able to find another better job somewhere else. So that's kind of a look at how, just a brief look at inequality and how we try to address that here in the United States.